for cheap prices. Time now for Trading Nation. Let's take a look at the two sectors leading the market this week, this month, and this year. Tech, consumer discretionary. Both groups are neck and neck, up about 2% in the last week and trading near all-time highs. So the question is, which is the better bet? Frank Cappelleri is with Instinet. Mark Tepper is with Strategic Wealth Partners. Frank, you first. Which way you going?
Hey, Bill, I'll go with XLY. We all know the XLY has been an uptrend for a long time. If you look at the chart go back 3 years, you know there's been some weakness along the way, including this year. XLY was down 11% in February, and again 9% in March. Both just led to buying opportunities and new highs. Now, year to date, both the XLK and XLY are up 15%. But that's a relatively new phenomenon. Because if you go back to the bottom panel of that chart, we see the XLY versus XLK really has been grossly underperforming until earlier, I guess, the end of 2017. What happened back then in November was that retail finally started to get some legs. That space continues now. And I think that still is in the early stages of doing so. So based on that and the fact that there are many extended names within the XLK, I prefer XLY.
All right. Mark, where are you going?
I'd have to agree with Frank. We definitely prefer consumer discretionary over tech. I think the bottom line is that lower unemployment means you've got more consumers who have the ability to spend. And I know wage growth is only growing modestly at 2.7% year over year, but we want to buy assets when there's the potential for a catalyst. And if you get any spike in wages whatsoever, which we do expect, then consumer spending can increase significantly, and that's really going to translate into higher profits for that sector. You know, in contrast, internet-based tech stocks had really, really high expectations. And for the most part, you've seen user growth fail to deliver and fail to impress when you look at like Twitter and Facebook. So with all that going on, we prefer consumer discretionary over tech.
All right. Mark, Frank, good to see you both. Thank you for joining us today on Trading Nation. And for more, you can head to our website or follow us on Twitter @TradingNation.
Technicians often look to wedge patterns as catalysts for stocks. A bullish wedge occurs within an uptrend and consists of two converging trend lines slanted downward. A break of the upper trend line is considered a bullish signal. Conversely, a bearish wedge occurs within a downtrend and consists of two converging lines pointed upwards. A break of the lower trend line is considered a bearish signal.